90% of startups fail, with 20% failing within the first year. In this video, we're going to discuss how you, as an early stage investor, could put yourself in the best position possible to succeed over the long run when targeting high reward early stage investments. If you want to see more financial tips, passive income ideas, and strategies to build wealth, then be sure to head over to our Instagram page at Jakeonomics to find your way to financial freedom. I also share my journey and quick thoughts on Twitter, so follow me there to stay updated on stocks that I'm currently investing in, how I'm making passive income during this recession, and more on Twitter at RealJakeonomics. And now, let's get into it. So first of all, what do I mean by high reward investments? What are they? They're really opportunities that have the potential for higher returns, but with the caveat that it also comes with the higher likelihood of losing some, if not all, of your invested capital. These types of investments expect a lot of uncertainty, expect a lot of volatility, and like I said, potential loss compared to, more conservative investments like large cap stocks or dividend stocks, stuff like that, right? So examples of high reward investments include stocks in publicly traded small cap companies, like I've covered in the past on this channel, and also private early stage startups. So this is private equity, stuff that again is not publicly traded, but that you can access through various different platforms. There's crowdfunding platforms that are available in Canada and the US, wherever you're at probably. So anyways, these types of investments are usually not suitable for individuals who are risk averse or have a very low tolerance for volatility. So it's very important to know where you stand and where you're at on that scale. On the other hand, for investors who have that higher risk tolerance and that higher appetite for higher reward investments, these types of investments could really offer the potential for higher returns over time and potentially life-changing gains if you do things properly and obviously have a little luck on your side as well. However, before investing in high reward assets, it is very crucial to do your due diligence, understand the risks, and be prepared to hold on to that investment for a long period of time. And you have to be, like this has happened many times, is a lot of people want the reward without accepting the risks. So they act like they accept the risk. They're like, yeah, I know, I could lose all my money. But when things take a sour turn, or the market takes a sour turn as a whole, and certain investments go down in value, like those people become very emotional. They start to blame other people. They start to really just stress themselves out over it. And so to those people, you need to be sure about certain things, and you need to really assess properly where you stand when it comes to your own investing strategy. Now, that said, if you're someone who is interested in high reward investments and who has that proper, those proper traits to handle that, then when it comes to investing in early stage startups, the first thing that you really need to do is look for product market fit. This means understanding the problem that the startup is trying to solve. How big of a problem is it? It's also important to understand the solution of that startup. What is it offering? And if there is a strong demand for that solution that people are going to be willing to pay for. As an early stage investor, you want to make sure that the startup's product is going to hold value in the customer's eyes, and that over time, more and more people are going to recognize that value. Secondly, you should have an understanding of the current world trends or macroeconomic trends as well. It's important to understand where the world is going and what past patterns could potentially repeat as well. You're going to be extremely successful with investing in these types of investments if you're able to pick up on trends early and be able to kind of predict what the future is going to look like. So the best way of doing this is to sit down, grab a piece of paper, close your eyes, and create that vision of the next 5 years, the next 10 years, and use that to guide your investments. Research all of your stock picks, all of your companies within that niche. You need to look at companies that are going to benefit the most from these world trends, right? So, some of these world trends right now, you can look at the green wave, right? You can look at gaming. These are you could look at blockchain. Like, these are movements that I think most people would agree. AI, with the ChatGPT, like these are trends that are going to keep going for the next little while at least, right? So envision how the company that you found is going to fit into that world vision in the next 5 to 10 years. And before we dive further into this, I do want to thank our friends at Zulu Trade for sponsoring this video. If you want to start trading or investing like the pros but don't know where to start, check out Zulu Trade. They're a trading platform with copy trading and social wealth management DNA. You can connect your brokerage account to the platform and have access to a wide selection of brokers. If you don't have a broker account, you can check out FXView for low commission trading. The link is in my last video to sign up. With Zulu Trade, you can easily copy top performing traders from different platforms and reach your investment goals. But that's not all. Their platform also includes powerful risk management tools like Zulu Guard and Automator, so you can trade even when you're away from your computer. With Zulu Trade, you'll have the tools that you need to make informed trades so that you can reach your investment goals. If you're interested, sign up for Zulu Trade today. The link is down below in the description. And thank you Zulu Trade and Zemoto Media for sponsoring this video. Now let's get back into it. Now, when looking at specific investment opportunities, the third and most crucial thing to consider when investing into early stage startups is the founder market fit and the management and their company business plan. So you really want to look into the founding team and the management team, as oftentimes when you're investing into early stage companies, like, let's be honest, you're betting on the horses running the race, because no matter what, no matter how good the product or service is, if the right people are not running the show, that company has a great chance of failing and becoming, part of that 90% that fail. So if I can't picture the founding team leading the charge internally and externally, then I will not trust them to manage my money. And, in terms of the business plan, there are many, many components that make up the business plan. So you might be wondering, oh man, like, where do I even start? Where do I start analyzing this? Well, check out the executive summary. So essentially, you're going to want to look at, okay, what is the mission? What are they trying to do? What are the products and services? What is special about them? Who is the target market? Why is that the target market? Financial projections, how big that market is. What is the TAM, the total addressable market, the TOM, right? You want to take all these factors into consideration. This is a very crucial part of the plan, as it's going to give investors an idea of the overall direction and goals of the company and how that can benefit you as an investor. So you want to keep the following questions in mind. So what does that plan entail? How many moving parts are there? How will the team execute that vision? Remember, 90% of startups fail, and 20% of them fail in the first year. So if the startup that you're considering investing in hasn't properly mapped out not only its path to market, but also its path to profitability eventually, then you need to think twice about investing into that company. Especially if any targets aren't being hit necessarily, investors are going to need to know that roadmap and, what are the stages of getting to where they want to go. Another thing you got to keep in mind is when investing into high reward investments is whether or not they have a competitive edge. One way to determine that is through product differentiation. So if the company sells a product, that is, of course. So this can include a unique design, right? Features that their competitors might not have, or certain benefits that make the product stand out from others in the market. For example, a company that specializes in eco-friendly products might differentiate itself by using sustainable materials or manufacturing processes, which sets its products apart from those that are competing against them. Another way a company could differentiate itself is through service differentiation, which is when a company offers exceptional customer service or support. Some examples include, faster response times, more personalized attention, a team of experts who are dedicated to providing support and assistance. So if your company of choice could differentiate itself through services, it could potentially create a very loyal customer base who will always, always come back to them, right? I mean, we see that with Apple, right? Whether it's like the product is good, right? But it's really the service that makes people come back again and again, right? And obviously the brand identity. Differentiation is a key strategy for businesses to stand out in a very crowded marketplace oftentimes, and in order to create a unique value proposition for their customers. Then, again, how are they going to make money? What is their revenue model? So, that is something that is the goal of a business, is to make money, right? And eventually not only make money, but you want to be profitable as well. Because if you're making, 100K in revenue, but you're bleeding money and you're spending more than you make, then over time, that's not going to be a very successful business, right? Over time, you're going to go bankrupt. As an investor, you're going to lose money, right? So that's not good. So how is it going to become profitable over time? What is the cost structure? What key metrics is the company going to be using to track progress and success? So for example, take an app, right? Monthly active users would be obviously a very key metric to gauge, okay, how many people are on the app, how fast is the app growing, that kind of stuff. And then what is the CAC, or the customer acquisition cost? So for every customer or every new user, how much is it costing the company to acquire this user? You also have to think about other stuff, like, do they have an unfair advantage? Are they the first mover, for example? Do the founders have relationships with different companies or partners or investors that will, or advisors that will allow for that business to really thrive and really take off and reach its potential? What is the go-to-market strategy? Is it, how many stages is that going to take, or is that going to entail? So these are all some of the things on the checklist that you need to go find yourself, solid high reward investments. And so, that's it on that. Here you could check out, like I gave my opinion on this site here, on FundFunder. This was a collaboration with Blossom. By the way, if you want to, Blossom is a social investing app. Not a plug or anything, but it's a great app. I was an advisor for them from the beginning, and I think they're a great founding team, and I'm very happy to be a part of that company. And so if you guys want to go check that out, I would highly advise it. It's a great platform. But anyway, so here again, you can read what I wrote here. These are very important things that I look for when investing in early stage products, early stage companies, sorry. So product market fit, macro factors, we talked about this, differentiation, business plan, management. So we talked about all these things, but if you want to see it on paper, here it is there. So fundfunder.com/investing/blossom-top-investor-advice, if you want to check it out there. Now, yeah, so that's about it. If you guys want more where that came from, you can go check out jakeonomicsfree.com and pick up a free report that I'm giving out right now. It's called Bear Market Profits. It's a nice little resource for you that you can get for free right now. So like I said, go check that out, jakeonomicsfree.com. I'll put the link in the description for that as well. And thank you for watching. If you like this video, you want more content like this and maybe a little more of a deep dive with different examples or whatever, give this video a thumbs up. Don't forget to subscribe if you're not subscribed, and see you next time.